Trump-era tax cuts set to expire after 2025, here's what you need to know. Several provisions from the Tax Cuts and Jobs Act of 2017 (TSJ) are scheduled to expire at the end of 2025 unless Congress takes action. Enacted under former President Donald Trump, the law included significant changes such as lower tax brackets, a higher standard deduction, and an enhanced child tax credit. The future of these provisions remains uncertain due to the unpredictable political landscape, with control of the White House and Congress in flux. Most Americans have enjoyed lower income taxes since 2018, but trillions in tax breaks are set to sunset without legislative intervention. The TCJ temporarily revised key aspects of the tax code for individual taxpayers, setting the stage for potential significant changes. "It's enormous," said Howard Gleckman, senior fellow at the Urban Brookings Tax Policy Center. "Pretty much the entire individual income tax code is on the table at the end of 2025. Both President Joe Biden and former President Trump, who are campaigning for the presidency, have expressed similar views on extending middle-class TCJ provisions. However, predicting the future of these tax breaks is difficult due to the unpredictable nature of political control over the White House and Congress. Individual income tax rates. One of the most significant changes under the TCJ was the reduction of federal income tax rates across the board. The top rate fell from 39.6% to 37%, and other rates were similarly lowered. Without updates from Congress, these rates will revert to their pre-TCJ levels after 2025, meaning federal income tax rates will return to 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. In anticipation of these changes, some higher earners are taking advantage of the current lower tax rates. For example, many are making Roth Individual Retirement Account (IRA) conversions while the brackets are lower. This strategy involves transferring pre-tax or non-deductible IRA money to a Roth IRA, resulting in an upfront tax bill on the converted balance, but potentially avoiding higher taxes in the future. Additionally, some are taking withdrawals from inherited IRAs sooner to minimize future taxes on required minimum distributions. The standard deduction. When filing taxes, taxpayers can choose between claiming the standard deduction or itemizing deductions, depending on which option reduces their taxable income more effectively. The TCJ nearly doubled the standard deduction, making itemizing less attractive for many. If the standard deduction reverts to its 2017 levels after 2025, as scheduled, more taxpayers might find it beneficial to itemize deductions again. Before the TSJ, about 70% of taxpayers claimed the standard deduction, but this figure rose to 90% by 2020 according to the Tax Policy Center. The SALT deduction cap. The TCJ placed a $10,000 cap on the state and local tax, SALT, deduction, significantly impacting taxpayers in high-tax states such as California, New Jersey, and New York. This cap was introduced to help offset the cost of other tax cuts in the TSJ. The cap is set to expire in 2025, but the political debate around it remains contentious. Some lawmakers argue that raising or eliminating the cap would primarily benefit higher earners, while others believe it is necessary to provide relief to taxpayers in high-tax states. The child tax credit. The TCJ doubled the child tax credit from $1,000 to $2,000 per child, increased the refundable portion to $1,400, and widened eligibility. These enhancements are scheduled to expire after 2025, which would revert the credit to its 2017 levels. In January, House lawmakers passed a bipartisan tax package that included further enhancements to the child tax credit. However, this bill has stalled in the Senate, and the future of the credit remains uncertain. The debate over the child tax credit is expected to intensify as the 2025 deadline approaches. Gift and estate tax exemptions. The TCJ also doubled the federal gift and estate tax exemptions, allowing more ultra-wealthy individuals to transfer assets tax-free to the next generation. In 2024, the tax-free limits on gifts during life or death rose to $13.61 million per individual or $27.22 million for married couples. These limits will drop by about half in 2026 without new legislation from Congress, which could significantly impact estate planning for high-net-worth individuals. Political and economic context. The expiration of these tax provisions comes at a time of heightened political and economic uncertainty. Both President Biden and former President Trump have signaled their intent to extend middle-class tax cuts, but their broader tax policies differ significantly. Biden has proposed higher taxes on the ultra-wealthy to fund various initiatives, while Trump has emphasized further tax cuts and deregulation. The outcome of the 2024 presidential election and the subsequent control of Congress will play a crucial role in determining the fate of these tax provisions. A divided government could lead to a protracted legislative battle over tax policy, while unified control by either party could result in more decisive action. Implications for taxpayers. As the expiration date for these provisions approaches, taxpayers should stay informed about potential changes and consider consulting tax professionals to optimize their tax strategies. This may include making strategic decisions about income recognition, retirement account conversions, charitable contributions, and estate planning. Income recognition strategies. One strategy that taxpayers might consider is accelerating income to take advantage of the current lower tax rates before they potentially increase after 2025. This could involve actions such as selling investments, receiving bonuses, or taking distributions from retirement accounts earlier than originally planned. By recognizing income now, taxpayers can lock in the current lower tax rates and potentially avoid higher taxes in the future. Retirement account conversions. Converting traditional IRAs to Roth IRAs can be particularly advantageous in a low tax rate environment. While this conversion incurs an immediate tax liability, it allows future withdrawals to be tax-free. With the possibility of higher tax rates post-2025, converting now can save significant tax costs in the long run. This strategy requires careful planning, as the upfront tax bill can be substantial. Charitable contributions. With potential changes to the standard deduction, taxpayers who regularly donate to charity might reconsider their approach. Bunching charitable contributions, where donations for several years are made in a single year to exceed the standard deduction threshold, could maximize the tax benefits. Donor-advised funds can also be a useful tool for managing the timing of charitable donations to align with tax planning goals. Estate planning adjustments. High-net-worth individuals should pay close attention to the potential reduction in the federal gift and estate tax exemptions. The current high limits provide a unique opportunity to transfer significant wealth to the next generation with minimal tax liability. Utilizing strategies such as gifting, trusts, and other estate planning tools before the exemptions are reduced can help preserve wealth and minimize future tax burdens. Business impacts. Business owners should also be aware of potential changes to tax laws. The TSJ included several provisions favorable to businesses, such as lower corporate tax rates and immediate expensing of capital investments. If these provisions are not extended, businesses may face higher taxes and reduced incentives for investment. Strategic planning around capital expenditures and business structures can help mitigate the impact of these changes. Broader economic considerations. The expiration of the TSJ provisions could have broader economic implications. Higher individual and corporate taxes could affect consumer spending and business investment, potentially slowing economic growth. Policymakers will need to balance the need for revenue with the potential economic impact of tax increases. Conclusion. As the expiration date for the TSJ provisions approaches, taxpayers and businesses should stay vigilant and proactive in their tax planning. The political landscape is uncertain, and the outcomes of upcoming elections will play a critical role in shaping future tax policy. Consulting with tax professionals and staying informed about legislative developments will be key to navigating these potential changes effectively.